Good morning and good afternoon. Thank you for joining today's Family Office Network's webinar series featuring KiwiTech. Joining us today is Neil Gupta, Chief Investment Officer and Founder, and Rakesh Gupta, Chief Executive Officer and Founder of KiwiTech. Both Neil and Rakesh will be teaching us about how KiwiTech has persistently led innovation toward creating a better tomorrow. Utilizing their unique experience acquired with a committed passion for innovation as a custom software development company, they take an active approach to provide end-to-end technology services to their clients, ranging from new startup founders and aspiring unicorns and established leaders in the tech space. At the end of today's presentation, we will have plenty of time for Q&A, and we really encourage your questions. Please use your questions chat option on the right side of your screen to send over all questions so we can answer them accordingly. Gentlemen, I will let you get started.
Thank you, Lindsay. This is Rakesh Gupta of KiwiTech, and I'm glad to be here. Thank you for attending. And I'd like to tell you a little bit more about KiwiTech and our unique model. So at KiwiTech, what we do is what we call cashless investing in startups. And what I'll do is I'll start with a little background on the founders. My brother, sister, and I were a sibling entrepreneurial team that had founded a company in the past called Aptara. Govinder Batra was our CTO there. And we scaled that company to 5,000 people, 500 people in the US, 4,500 people in India, and a few people in different parts of the world, UK, Germany, and Australia. And that was a content technology services company that we sold in 2012. And what that did is it taught us a lot about, providing services using onshore and offshore. And then after we sold that company, we were thinking about how we apply that to the startup space. And that's where we came up with our unique model in 2013, which I'll talk more about in a minute. On our board, in addition to the four of us, we have three outside investors. There are three largest outside investors. Combined, they've invested $8 million in the company. And all three of them have interesting but different entrepreneurial backgrounds and are very good value-add board members for us. And then in terms of our core model, KiwiTech is, what we do is pretty unique, as I mentioned, in that we'll do technology development for a startup. Say there's $500,000 of development for a startup. We would sign a deal with them where they would give us $250,000 in equity. Let's say their valuation is $5 million at the time we do the deal. Then we'd get about 5% of the company. And the other $250,000 that pay us over a course of 2 or 3 years as they do the development. So what this does is it creates a very strong partnership between KiwiTech and the startup and a collaborative relationship where our main goal is with the money that they pay us is just to cover our costs. Our upside is really in the equity. So it's a very strong strategic alignment. We want their equity value to increase and they want their equity value to increase. We supplement that with a startup ecosystem, which is a series of events. We used to have about 30 to 40 demo days per year, and they used to be in different parts of the country. But then last year, as we went into virtual mode, we expanded our roster of events to over 100 this year, and includes VC panels, family office panels, venture fairs, a variety of events that give the startups different opportunities to learn, to connect with investors, to connect with other startups, to really kind of help them as they grow their own company. And this ecosystem is a nice value add for the startups that we work with. And then in terms of deal flow, last year we reached out to 28,000 companies. For a period of time, our deal flow was primarily outbound. This year we've kind of moved to a combination of outbound and inbound. So the top of the funnel is going to be about double this year than it was last year. We get positive responses from about half of them. That leads to about 4,000 calls followed by follow-up, Zoom calls or meetings, and led to 100 portfolio companies last year. And today we have over 400 portfolio companies, and we expect to scale this to over 1,000 portfolio companies in the next few years. So today the deal flow is a mixture of inbound and outbound. Inbound primarily from our events, because we have a lot of startups that attend our events and learn about our ecosystem and want to participate and benefit from it. In terms of the In-kind investment, that's been growing pretty steadily year on year. We started out kind of just experimenting with it in 2013, and you can see last year we acquired about $31 million in in-kind equity. And this is the equity we get through the contracts that we do with startups. And that number is continuing to grow. And obviously, out of 400 some startups, there are going to be some very interesting hits. We have startups that are headed towards becoming unicorns and startups that should have very good results. Of course, there is a high failure rate. There are a lot of startups that don't work out, but overall, we're finding a lot of interesting successes. And sometimes where the successes come from surprises us. One of our top companies is a food tech company that we received in-kind equity in about 4 years ago. And food tech was a challenge space at the time, but this company has done extraordinarily well. So examples of some of the startups in which we've invested: UrbanFT is a fintech SaaS platform. They have over 500 banks that use them for digital banking. So these are mid-sized banks, and UrbanFT can provide them with the full infrastructure. We started with that company pre-revenue, pre-product, and they've scaled quite a bit. It's a SaaS model. We have a Uber for buses company called Our Bus. Our Bus has merged with another company called Rally that was backed by Daimler Mercedes-Benz, and now is continuing to scale. They were at a $25 million run rate pre-pandemic, and now they're getting back to that probably by the end of this year. So that company has got very good momentum. And just some other examples. There are obviously a lot of startups to talk about, but just a few examples here. BeWell is a health tech company that provides healthcare technology to medical systems and large employers for them to connect their constituents with healthcare providers. That company has received a strategic investment from Walgreens and from other VCs, so it's done very well in terms of follow-on funding. Hungry is the food tech company I talked about. It started as a corporate catering platform, but pivoted last year to deliver food to residences, and their chef-prepared meals delivered at very reasonable cost. And that company is scaling very quickly. LVH is a Airbnb for billionaires. There are a number of notable billionaires that travel with them. They're high-end villas around the world, and that company, as of Q2, is at a $25 million revenue run rate. So we're very excited about that company as well. And then in our event ecosystem, as I mentioned, this has scaled quite a bit. Before the pandemic, we were doing 30 to 40 events. We had about 30 to 40 people coming to each event. And then last year, we were able to scale this up and over 100 attendees at each event. And now this year, we expect to do over 100 events. So this has become a very important part of our ecosystem. Zoom has really helped, these virtual events make it much more efficient. We can get good speakers, because it's only a 45-minute commitment for a speaker to come and speak at one of our events. So, for example, in a venture capital panel, we had a speaker from Edison Partners, from NEA. So we have good VC partners and Sine Ventures and Storm Ventures. So very good VCs that come and show up at our events. And these venture capital panels, family office panels, they attract sometimes 300 to 500 people at a single event. We had a family office panel that we kicked off in August. We do this regularly as well. And we had top family offices, including Forbes and Koch family offices at that event. And then, of course, we are big proponents of female founders and minority founders. We think that in the past, not enough capital has gone to both female founders and minority founders, and we think, therefore, one can even have better success investing with both female founders and minority founders. So we have events that are specifically tailored to that, including panel discussions and presentation by female founders. And then we also do workshops where startups can come and learn about certain things such as new technologies. This workshop was on AI, machine learning, blockchain. So it gives startups an opportunity to learn more about new technologies. And then one thing we're doing is we're expanding our ecosystem. So we really started out with this technology development services, which is a core business. And in December of last year, we acquired Graphite Financial. This was spun out of a VC firm in New York called FFVC. And the Graphite Financial mainly catered to VC-backed startups, so portfolio companies of Bessemer Ventures, Google Ventures, recognizable venture firms, and they would provide them with a regular monthly service to take care of all their accounting statements to make sure their accounting was done well. And this is a company acquired in December. First half of this year, they added 35 new VC-backed startups to their client list, and they're continuing to scale. There's some nice synergies with KiwiTech as well. And our plan is to do 3 more acquisitions over the coming months. We plan to do one in crowdfunding. Crowdfunding is a space that's expanding quite a bit, especially with the changes that happened in March. And also technology development with a backend in Eastern Europe to supplement our backend in India. Today, we have about 500 people in the company, about 50 people in the US and 450 people in India. Would like to supplement that with people in other geographies as well. When we acquire companies such as the finance and accounting company or the crowdfunding company, we're able to leverage our offshore capabilities to increase their gross margin. And we're also able to leverage our online events and our own portfolio to increase their top line. So there's kind of a top line impact and a bottom line impact when we acquire a company. So we see this as a good way to kind of expand out the KiwiTech platform. It becomes kind of like shared services for startups. If you look at, for example, Accenture or these large services companies, they're providing a variety of services to enterprises. We're becoming a similar kind of partner to startups with collaborative models such as the in-kind investing and the startup ecosystem as well. And in terms of our financials, we did $40 million in revenue last year, expect to grow to $56 million this year. Our revenue is a mixture of cash and in-kind revenue. And we did $25 million of net income and $36 million of net income expected this year. This again is a mixture of cash and in-kind. And we're continuing to scale this model. And our target is in the next few years to get to $100 million in EBITDA, of which $25 million will be cash EBITDA and 75 will be in-kind EBITDA. And that will be a point at which we think that we'd be ready for an IPO. So this is something that we think we have all the pieces in place and are continuing to scale the company. And we have set up our current round for KiwiTech as a convertible note, which has a current pay of 8%, a share price of $8 a share, which is equal to 1 times the book value of last year's portfolio as of the end of last year, and about 3 times EBITDA. So, and this has a maturity date of 2024. So it's set up in a very, I would say, family office friendly style. So that's KiwiTech, and I'd welcome any questions.
Hi, Neil. Thank you so much. I appreciate that. Yes, to all of our attendees, jumping into Q&A. Again, we really encourage any questions that you have so we can utilize this time to ask Neil and Rakesh to answer them for us. So I'm just going to start off right off the bat here, gentlemen, so we can kind of get some questions going. Let's see. Let's talk a little bit about acquisitions. Okay, so how do you think acquisitions can supplement the Kiwi ecosystem?
Well, the acquisitions can be very synergistic. For example, we are looking, we're looking to acquire a crowdfunding marketing agency. Right now, we are actually launching some crowdfunding campaigns. This quarter, actually, we expect to launch 10 new crowdfunding campaigns. And we formed a partnership with WeFunder, a strategic partnership where they give better terms to our startups. And the acquisition of a crowdfunding marketing agency allows us to provide that as a service to our startups, because raising money or capital formation is one of the most important things for a startup. For them to take their idea and turn it into a business, they need cash for that. And the acquisition of a crowdfunding marketing agency allows us to really build that out. And we think that from our pipeline of deals, there are about 10 startups that would launch in Q3, And by Q1, we would do about 25 new campaigns every quarter. So we have pretty significant deal flow that we can leverage for these acquisitions, crowdfunding being an example, finance and accounting, digital marketing. As we bring these new services on board, we not only provide technology development, we provide these other services. So someone comes with an idea and they have their business and they can focus on their business and allow us to help them with the more mechanical, parts of the business in terms of the different functional areas.
Great, and I'm glad that you brought up crowdfunding. So what is your opinion, Rakesh, on the future of crowdfunding in the tech space?
Well, crowdfunding has become very interesting this year because in mid-March, on March 15th actually, the SEC changed the rules for crowdfunding. They improved them from a startup's perspective. They increased the limit of non-accredited investors in a crowdfunding round from about $1 million up to $5 million. So now a crowdfunding round is pretty competitive with a seed stage fund or a VC fund because a startup can raise up to $5 million from non-accredited investor and unlimited amount from accredited investors. So in a single crowdfunding round, they can have a combination of non-accredited and accredited investors. It provides a benefit to startups in that they have a more reliable kind of regular way of raising capital, and they can leverage marketing through social media and through other channels to get investors. It allows non-accredited investors access to these deals that until to date were only available to accredited investors. So there's a benefit for them. What's interesting is after they changed those rules, the quality of startups that began coming to crowdfunding improved quite a bit. After March 15th, a number of Y Combinator companies, Techstars companies, they started announcing that they're going to do crowdfunding rounds. And actually about 10 days ago, a fintech company, Mercury, which is a bank for startups, raised money on crowdfunding. And what was surprising about this is that they're a unicorn. They have a $1.6 billion valuation. They had just raised $110 million from Andreessen Horowitz and a number of other notable VCs, but they chose to do a crowdfunding round to create greater stickiness with their customers. They want their customers to have the opportunity to participate in the upside of their equity. So they opened up a crowdfunding round and in about, I think it was like 10 or 12 hours, raised about $10 million to supplement the VC money they had and develop more of a relationship with their customers. Because if a customer invests in Mercury, for example, they're more likely to use Mercury as their bank than another bank.
Gotcha. Okay, so we have a couple questions about some financing things here. So we would love it if you can elaborate a little bit more on the 50-50% equity and payback approach. And, what would the price be per customer? I'm kind of incorporating two questions into one here because they're similar.
Okay, sounds good. Thanks, Lindsay. So in terms of the 50-50 model, the way it works is what we do is we kind of establish a price sheet or a rate sheet that's based on about $35 per development hour. So that's an attractive rate. It's maybe a little bit of a premium to typical offshore rates, but significantly less than domestic rates. And the startup would effectively in cash be paying $17.50 per hour, which is very attractive. That's a very attractive rate, and it conserves their cash. For startups, the key thing in the early stages is conserving cash, and because raising cash takes time, it takes effort, it's difficult to do. So we become effectively like an investor partner with them because we're providing a meaningful discount on the technology development. So at $35 per hour, they're only paying $17.50. They're getting a subsidized rate, you could say. And our objective is to cover our costs with the cash that we get, and really participate in the upside with the startup as they grow their business. And that's how we have that set up.
Okay, wonderful. Let's talk.
Sorry, another question might have been part of that. What was the minimum size of a project? I didn't want to miss that as part of that compound question.
Yeah.
So yeah, our average projects probably, our average in-kind equity is probably around 200,000. I'll let Rakesh elaborate further.
Yeah, that's right. Yeah, average is probably around 200,000 for an in-kind project, the in-kind piece. And but they vary quite a bit. I mean, we can have a $100,000 SOW, 500,000 could be $1 million SOW.
Okay, perfect. Neil, did we get the whole question answered there, you think?
I believe so.
All right.
Yes.
Okay, next question, and I hope I'm going to pronounce this correctly. Does SaaS-based strategic goal systems performance management fit into your strategic support future?
Oh, wow. Okay.
A lot of strategic going on there.
SaaS. Well, yeah. Well, SaaS is definitely something that we cater to. We have a lot of SaaS portfolio companies. It's a space. It's an area that we like a lot. We like the kind of highly recurring nature of SaaS companies. So it's definitely an area that we like a lot, and we have a number of portfolio companies in that area.
Wonderful.
Across different verticals.
Thanks, Rakesh. Let's talk a little bit about exit, your plan, your strategy. If we can maybe elaborate a little bit more, again, just high-level overview on the ask here, that would be great as well.
Yeah, so the capital that we're raising now is primarily to fund acquisitions. The company has raised over $30 million in capital over the last, over its development. And we're adding on to it with this convertible note round. And this will allow us to do more acquisitions. And the way that we're doing acquisitions is we pay part of the price up front, we pay part of it in KiwiTech stock, and part of it in earnout. So we're able to be pretty efficient in terms of doing acquisitions, because the companies we're acquiring companies that are in it for the long game, for the next 2-3 years at least, And so their compensation is spread over 2 or 3 years. There's some upfront, and there's the rest is from a KiwiTech exit. And in terms of an exit for KiwiTech, we're looking at, we'd like to do an IPO in the next 2 or 3 years. We think that we have all the basic pieces of that coming together, with technology development already as our core business, adding on finance and accounting, crowdfunding, digital marketing, and really having a robust offshore setup, probably in between India, Eastern Europe, and South America. That also covers different time zones. We think that we're going to have a pretty robust platform. And so far, it's interesting because we don't see a directly competitive model at scale yet. I'm sure it'll come in the future, but right now we don't see that.
Great. So just to kind of reiterate, you don't see any like competition out there at the moment? Anyone that's doing anything similar?
Yeah, I wouldn't say there isn't any competition. There is competition, but it's not at scale. I mean, we do have other companies that say, hey, we'll take part of our fee and equity, and especially maybe when they're competing against us, they might agree to do that, But we're doing it in a very systematic way across a lot of startups and building a pretty significant portfolio. There are clearly software development shops and marketing agencies, even law firms, that have taken part of their fee and equity and done very well with that model. I mean, law firms like Wilson Sonsini did in the Bay Area, did very well. The Uber app was developed for in-kind equity. The Facebook office was painted for in-kind equity. So there's some interesting success stories with this model of in-kind investing.
Gotcha. That's great. Yes, those are big ones. It's hard to envision life without Facebook and Uber these days, Okay, so yeah, next question. Do you have a minimum cash on hand or receivables position for your startups before you will consider them?
No, we don't have a minimum, but we do track how the startup is doing in terms of cash funding. I mean, we do track that pretty closely. I mean, the services that we provide, we're very careful. In the past, we worked with enterprises in our last company, so there were never any payment issues. It's pretty rare to have a payment issue with an enterprise. With startups, you got to be mindful of how are they doing with their raise, and do they have the ability to pay their bills, and if they get into a cash crunch, then you probably want to take a little bit of a pause on the development, not run up bills that can't be paid.
Yeah,
so that's
definitely
something we're very careful about monitoring.
Great.
Something that we didn't have to think about in our last company, but we definitely have to think about that at KiwiTech.
Wonderful. That is, for now, all the questions. Hopefully a few more will come in. Is there anything that you guys would like to add while we wait to see if there's any additional questions?
I'll let Neil make some comments. Would you like to add something?
Sure. Yeah, I think as Rakesh said, we are a family-run company and a family-friendly company. So we have dozens of family offices on our cap table already. Some of them are very significant that you would have heard of, and many, high net worth individuals, people who have started public companies, hedge fund managers, it runs the gamut. So it's I think a big part of our model because the family offices have individuals who have expertise in different spaces and areas, which can help our startups as well. So even if we go down the institutional funding path down the line, it's important for us to bring more and more family offices and high net worth individuals into our model, for many reasons besides capital.
Wonderful, thanks, Neil. And I do want to say as well to all of our attendees, I'm going to be following up with everyone individually. So if there is any additional questions that come up, I would love to make sure I get you introduced to Rakesh and Neil so we can get those answered as well. That still seems to be all the questions for now. Gentlemen, it was such a pleasure having you join us. We really appreciate it, and I will be in touch with everyone.
Thank you, everyone.
Lindsay.
Thanks,
Appreciate it.
Lindsay.
Thanks,
Have a
everyone.
great day.
Bye.
Thank you.